A big data drop is coming that could help or hurt the stock market. And the big question is buy now, pay later dead in the water? And finally, is the US dollar bound to tumble? So is it time to hedge? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. That was a very laid-back, I'm a Paul Rickard. I've never seen you lack such enthusiasm. Is it because you're looking at this big data drop and you're worried about the stock market?
I'm worried about the inflation number tonight in the States, Peter. That's the big one.
Too.
I don't really think the employment number tomorrow in Australia is that important, but look, the US tonight, expectations of the CPI will be 8.8%. That's up from the month of May. The market would probably take that as okay. It's more the risk of it overshooting.
The nines,
The nines, and if it's 8.5, I don't think it's really going to matter too much. The core number, I think, is expected to be a little better.
Yeah, and that's really important. The market does react to headline.
The market and the press is going to go for the headline, and there's some reasons why the core is down, including some base effects from the last time because it takes out a month and so forth. But that's a really important number for the US market, Peter, because 98% of people think that the US will increase by 75 basis points. If you get a really bad number tonight, who knows what they'll start to think? It might be 75 this time and a 75 again the next time. So
that will really hurt stocks.
And that will hurt stocks. So that's a huge number. The Aussie employment number tomorrow. Look, it's important, but I think
it's just something about our inflation.
Yeah,
that's all.
This is the one to
but
worry
you're right.
about.
The Wall Street's going to be the most important one, and I think the really important issue that we have to focus on here is the reaction to the number. I saw some really interesting analysis by a guy called Larry Williams, who's a famous US tech analyst, and he talks about the stuff I never heard of it before. The sticky and the flexible CPI, and the flexible CPI actually has peaked. But it's the sticky one that often follows the flexible. But it's going to be very interesting to see what happens in this number. I'm hoping that the flexible influence is actually going to bring down the sticky one, but we don't know. Fingers crossed it's not a bad number.
It's also interesting they've sold off a little bit into it, which you've got to say is more of a chance of that you'll get some sort of bounce tomorrow, but let's see what happens, right?
Yeah, let's go to the buy now, pay later. We saw Zip has dumped its Sezzle play, helped its stock price. Afterpay, clearly hasn't done well since the merging with Block. But is buy now, pay later really dead?
No, look, it's not dead, Peter. This is just a temporary sort of... the market was overvaluation, and we've seen the huge change in the valuation of Klarna. But look, apparently Sezzle had some reasonably disappointing quarterly numbers in terms of that they were... the growth hasn't quite been there. It's just like any market, it matures, right? I mean, it's found there's a lot of people going to continue to use buy now, pay later. Some of the projections, like all those things, got overhyped. Higher interest rates don't help buy now, pay later people because they're funding it effectively. So that eats into profits, and they've got to demonstrate that there is a long-term profitability. So
and there's also lots of new players have come in the market.
And everyone became a buy now, pay later guru. So I think this is inevitable. I mean, I think there's value in SIP, but I thought that a lot higher up, Pete, and it's going to take a while for the market to reassess that. So it's not dead. But that's just nonsense. But
it takes guts to buy it and wait for it to rise.
You're going to have to be patient. So if you're buying Zip or Block at the moment, or the others, you're going to have to be patient with it because the market's not going to fall in love with it straight away.
And what's going to be fascinating, Paul, about reporting season, which starts late July and is really big in August, is remember this: some of the companies that have been smashed by the stock market is not necessarily based on how well they're actually doing and how well they might be doing. It's all speculation about what interest rates might do to this company. But it may well be wrong. It may well be an overreaction by the stock market, and these companies might just come in and say, we're doing pretty well and the outlook's not bad, and their share price will take off.
Yeah, and look, we know that Zip, for example, because they're in our building, Peter, we know they've been cutting costs, right? They've been cutting staff.
Yeah. Less cars in the parking space.
Less cars in the parking area downstairs. So... Look. I still think it's a solid company. I think it was probably the right move to dump Sezzle, given what's happened to their share price, given the relativities, and get it focused back on the Australian business and a little bit what it's doing in the US.
Very interesting. A very safe investor like you going for a tech stock, Paul. It's going to be interesting to see how it goes.
Last time I get to buy later, but that was some higher up folks. So
he's not always right, but eventually he will be, I reckon. The US dollar bound to tumble.
Yeah, look, Australian investors shouldn't ignore this because we've seen, almost unheard of. The US dollar is at its highest level in over 2 decades, almost at parity with the euro, right? And so
interest rate rising quickly will do that.
Yeah, and so that's you got to say longer term. That's going to be good for US inflation because it's going to mean anything they import is a lot lower. But that's a question mark because it can't go up forever, right?
Yeah.
And there's been this huge flow of money into it. So the Aussie dollar has actually done really well, just not against the US dollar. It's high against the Kiwi, it's high against the euro, it's high against the pound, it's high against the yen. It's just fallen against the US dollar because it's just taken off. Now, I think it is probably time to hedge because, we're now at 67.5 cents. Look, obviously if you're hedging, you're reducing the opportunity from further downside, but, we're now getting below sort of that long-term range. So the long-term range is around about 75 cents. When it's in the 60s, you've got to think at some stage the US dollar won't be able to go up forever, right?
Yeah. And I guess if you took a long view of, say, 1 year, you'd kind of think the Ukraine war would be over, and that would be better for Europe. So euro would probably go up, US dollar would probably come down. You'd think a global growth story would be on. That'd be good for the Australian dollar and the Australian miners and whatever. So that's like your 1 year view. And so things like IHVV, which is like a hedge version of the IVV, which buys S&P 500, could be an interesting play. Not advice, just an educational point of view. But I'm considering it, I must admit.
Yeah, great time to travel to Europe. Forget the US, right?
That's right.
That's the other way to play it, right?
I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.